Hello, everyone, and welcome back. Today, we're going to tackle a very common question. Should you invest in ETFs or should you invest in individual stocks? The truth is, it's not an either-or decision. Both ETFs and stocks can play an important role in a successful investing strategy. What matters most is understanding the differences, the benefits, and the risks of each approach, so you can decide what balance makes sense for you. Let's start with the basics. When you buy a stock, you're buying ownership in a single company. That means you share directly in its successes and its failures. If the company grows, you benefit. If the company collapses, your investment can go to zero. When you buy an ETF or exchange-traded fund, you're buying small pieces of many companies all at once. That could mean all the companies in the S&P 500, or in a specific sector like technology or energy, or even across countries and regions. ETFs are built for diversification so that one company's failure doesn't wipe out your portfolio. This difference has huge implications for risk. With an ETF like the S&P 500, your investment would only go to zero if the entire U.S. economy collapsed. That's extremely unlikely. But with a single stock, bankruptcy is always a possibility. Blockbuster, Enron, Lehman Brothers, all once famous companies that went to zero. Now, there's also a difference in how much work each requires. Buying and holding ETFs is relatively simple. Once you've picked the funds, the managers do the heavy lifting. As companies are added or removed from the index, the ETF automatically updates. Owning individual stocks takes much more effort. You need a clear process for evaluating businesses. You need to review financial statements, track performance, and make decisions about when to buy, hold, or sell. For many investors, this can be overwhelming or simply too time-consuming. Another major consideration is your emotions. Markets are volatile, and prices swing between optimism and fear. With ETFs, the best approach is usually dollar-cost averaging, investing a fixed amount regularly, regardless of whether the market is up or down. Over time, this smooths out the bumps and keeps you invested through good and bad markets. With stocks, you need much stronger emotional control. Individual companies can drop 20, 30, even 80% in a short period of time. That's painful to watch, even if you believe in the company's long-term prospects. Staying calm and sticking to fundamentals is much harder when you're concentrated in single names. This brings us to another comparison: ETFs versus mutual funds. Many people wonder if mutual funds are a better option. The reality is that mutual funds are often more expensive and less effective. They are actively managed, which means fund managers make frequent trading decisions. That adds costs, usually around 1% per year in fees. ETFs, by contrast, are passively managed and much cheaper, often less than 0.1% in fees. Over decades, that small difference compounds into a massive gap in returns. So if low cost and long-term compounding matter to you, ETFs generally have the advantage. But what about growth potential? Can ETFs really beat the market? The answer is that ETFs are designed to match the market, not outperform it. If you want the chance to earn higher returns, that's where stocks come in. By carefully selecting individual companies trading below their true value, you can potentially generate results above the market average. And this brings us to a crucial principle: price versus value. Whether you invest in stocks or ETFs, the goal is the same: to buy value for less than it's worth. In other words, to buy a dollar for 70 cents or even 50 cents. That's what creates long-term gains. There's often a false distinction between growth investing and value investing. In reality, all investing is value investing. Even if you buy a fast-growing company, you're still trying to pay less today than the company will be worth in the future. The only difference is how much growth you're expecting. Finally, let's zoom out to the bigger picture. The history of markets shows that no matter how much bad news has happened — wars, recessions, inflation, crises — the long-term trend has always been upward. That's because economies grow, innovation continues, and businesses adapt. The real challenge isn't the math. The math is simple. The real challenge is managing your emotions, staying invested during downturns, and consistently applying your strategy. So here's the conclusion. ETFs are a great starting point for nearly everyone. They're simple, low-cost, diversified, and resilient. Stocks can add higher potential returns if you have the time, process, and emotional discipline to pick and hold them. And for many investors, the best approach is a combination of both. ETFs as the foundation, and carefully chosen stocks as the opportunity layer. Investing isn't about reacting to every headline or market swing. It's about discipline, patience, and matching your strategy to your goals. Keep that perspective, and both ETFs and stocks can help you build long-term wealth. Thank you for watching. If you found this helpful, don't forget to like the video and subscribe so you never miss our latest content.